Hey, good afternoon, everybody. Welcome to Strategy Now at MarketStream.live. My name is Joseph Cusick with the Cusick Group Securities offered by Money Block. So I want to break down a strategy that you could use in your portfolio. It's a short-term strategy. For those of you that have never traded options, this is going to be a little bit of a learning curve here, but it's going to be straightforward as far as risk and reward. It's going to be very clear. What I want to do is take a look at an ETF that tracks Chinese stocks. And the reason why is that tonight, overnight, China will be releasing some key economic data, specifically their CPI, Consumer Price Index, as well as their Producer Price Index, the PPI. You've heard that talked about here in the United States. Well, we have it globally. There's a little bit of a negative tilt right now in the Chinese markets. As of today, you have FXI, which tracks these large cap stocks in China, trading up 2%, up 76 cents at 38.41. Now, what's interesting here, though, is that it's been a very choppy trade, and it's been primarily bearish going into this economic data over the last 4 sessions. Now, today it is trading up, so we do have some short-term and intermediate-term bulls, but we have a lot of choppy action here. Now, with this type of strategy that I'm about to talk about, really what we want to do is we want to take a strategic approach that takes advantage of the current sentiment in the market and this binary event, but we want to do it in terms of a fixed risk, fixed reward. So what we're proposing that you look at when you have that kind of setup where you have a market sentiment, you have a moderate risk tolerance, you want to have a fixed risk, and you're willing to have a fixed type of total return, then this particular strategy we're going to discuss, a bear put spread, is perfect, especially if implied volatility is low. And as a matter of fact, if you look at FXI, implied volatility is trading at 17.5. What does that mean? That basically is a number that's calculated by the options market makers that forecast potential moves in the stock. And in terms of how low or how high it is, we look at the implied volatility rank. In other words, we rank the current implied volatility over the 52-week average, and right now it's ranked at 10, 10.8 to be specific, which telling you that there is not a heightened sense of huge violent moves in FXI. And taking a look at this going into the event, FXI is, well, actually, let's look at it. As a matter of fact, I can scroll down. Let's see what the options marketplace is pricing in. We use the straddle strangle market. For those of you that are new, all I'm doing is look at the closest at the money call strike and put strike. That's the 38 strike. I add that up. Then I take the first strike out of the money put. That's over here to the right. And the first strike out of the money call. Basically what I'm doing is I'm adding up the ask price, this column here, 49.93 and 18. Which is basically giving you, let's say it's about 75 cents. It's closer to 80 cents of total capital in the straddle strangle market. You divide that by 2, it's pricing in the potential for FXI to move 40 cents. That's a 4% move going into the CPI and PPI data that's going to happen overnight. So with that being said, what we want to do is take a look at a May position that actually takes advantage of the sentiment that the market is exuding, which is, let's say, slightly bearish. And we want to give ourselves some time. So we're going to look at about 40 to 45 days. That gets us into the June expiration cycle. And specifically, we're going to look into the June 16th. Which is 38 days left until expiration. Now, I like to put probabilities on our side. So when you buy options, your probability of potential success is based on really rudimentary the delta. So with stock trading at 38 and some change, I'm going to look at the first strike in the money put because I'm looking for a potentially bearish strategy. So I'm going to look to buy the 39 puts, and it looks like they're being offered at $1.09. So that means for every 100 contracts, I have to have $109, or for one call put contract, I have to have $109 in my account. Now, this will appreciate by 58 cents for every dollar that FXI goes down. Now, FXI is they're only pricing in going into this event alone tonight, 40-cent drop. If the underlying drops 40 cents, these puts should increase roughly by about 20 cents. So that'd be basically trading right around $1.30. Now, I'm going to offset this purchase price by selling the out-of-the-money puts, specifically the $36 puts. They have a delta of 13, which is telling me that right now those only have a 13% probability of being in the money at expiration. So this particular strategy that's trying to take advantage of our bearish sentiment in China between now and June expiration, if I buy the $39 puts, those expire in 38 days, sell the $36 puts, those too expire in 38 days, I'll have to pay roughly right around 94 cents or $94 per contract. Now, I have 38 days for the underlying to potentially drop, and I have a binary event just this week alone that's pricing in the potential for the underlying to move about 40 cents either up or down. And if it moves to the downside, that could get it down to the 37 and some change, and I could potentially look to pull this trade off for a profit. So right now, again, recap, I'm buying the 39s, selling the 36s. So I have limited risk, but I'm also giving up some of that profit potential to have reduced capital exposure from purchasing that option outright by selling the $36 call. And so bottom line is if I think with some conviction between now and June, the next 38 days, that FXI could be trading at or around $36 over the next 38 days, I could have a potentially profitable trade. As a matter of fact, there's a 61% probability that I could have at least a 50% profit between now and expiration in this particular strategy. So this is how you would play if you have a bearish sentiment and implied volatility is low. You buy one strike in the money, you sell a couple strikes out of the money against in the same expiration month against the option you bought. That's a bear put spread, and that's how you can play a mildly bearish sentiment in low implied volatility. All right, folks, that is it for strategy. Now, do us a favor. Check us out on MarketStream.live. As a matter of fact, if you go down at the bottom on the home page and you scroll down to Does Your Core Investment Portfolio Fit You? I have a absolutely free questionnaire that if all you have to do is put your first name, last name, and email address, that's it. You answer a handful of questions, should take no more than 3 to 5 minutes. And what I'm going to do is not only send you what your risk number is, in other words, you might think you're aggressive or you might think that you need to be or you are personally conservative. After you take this risk assessment, I will send you not only your risk profile number from 0 to 100, 0 being the most risk averse and 100 being the most risk taking type of individual. And then I'll send a 6-month portfolio, one that fits your risk number, and it'll give you the risk reward for the next 6 months with a 95% probability. All of that completely free. So check it out. All right, we'll be back online at 3:30 Eastern Time. We're going to be doing Tech Talk. I'm going to take a look at some markets as well as some names that are going to have some binary events. We'll take a look at FXI maybe as well as far as market movement going into their events and some other stocks. So join us 3:30 Eastern Time here at MarketStream.live for Tech Talk.